In this video, you're going to learn how to calculate your effective tax rate so that you can make better, educated decisions about your long-term financial plan. Question: do you think you will have a lower or higher effective tax rate in retirement compared to what it is today? Time to crunch some numbers. Let's get to work. What's up, guys? I'm Kay Scholl. Welcome to another financial awareness video. We're going to jump right into it today. Your effective tax rate as an individual is the total amount of taxes you owe divided by your taxable income. There are some key words I want you to focus in on regarding what I just said. Number one, your effective tax rate is not the same as your top tier marginal tax bracket that you're in. Not all of you, but when some of you are out with friends and you mention how frustrated you are about being in a high tax bracket, you're simply announcing to everybody your lack of knowledge of knowing how to legally reduce your tax liability. What you should be excited about is how well you did to lower your tax rate. Number two, taxable income is not the same as your total income. I just did a video, and I'll link it in the description below, regarding some of my favorite tax deductions and tax credits that you should be aware of. Speaking of tax brackets, check this out. This is the 2020 federal income tax bracket if you are a single filer. Basically, for the first $10,000, you're taxed at 10%. From $10,000 to $40,000, you're taxed at 12%. And for the next roughly $45,000, you're taxed at 22%, and so on and so forth. As an example, if you're single and make $58,000 per year, your effective tax rate is not 22%. Let's break this down. You make $58,000 per year and you put away 6% into your 401k to get your employer match of 3%. Good job. $58,000 minus $3,480 equals $54,520,000. Let's assume you're a W-2 income worker and you have no other work-related deductions. But according to Experian, if you're in your mid to late 20s, then maybe you have around $27,000 in student loans. Assuming a modest interest rate, you'll have around $1,000 in student loan interest that you paid. So your taxable income is at $54,520 minus $1,000 in student loan interest as a deduction, because you don't have to itemize your tax return in order to take advantage of this particular deduction. You then take the standard deduction of $12,400. This brings your taxable income down to $41,120. Now, are you technically in the 22% tax bracket? Yes. However, your taxable income is now only $41,120 compared to your gross income of $58,987 plus $3,630 plus $219 equals $4,836. 4836 divided by 41,120 is 11.76%. This is your effective tax rate, not 22%. Here's an example if you're married. Let's assume you make $58,000 and your spouse makes $120,000. And in order for both of you to be gainfully employed, your one young child has to be in daycare. You're smart savers, so you put away 6% into your pre-tax 401k and your spouse puts away 10% into their pre-tax 401k as well. That's $178,000 of total gross income. And then we subtract your 6% contribution and also subtract out your spouse's 10% contribution, and we're now left with $162,370. Now, your student loan interest starts to get phased out around $140,000 married filing jointly. So for the sake of this conversation and this example, even though there might be a little bit of student loan interest you could deduct, let's just assume there's no interest that you're deducting against this income for student loan interest paid. That leaves us with $162,370, and then we take away your standard deduction of $24,800 for the 2020 calendar year. So as you can see from the tax brackets here, $1,975 plus $7,260 plus $12,610 equals $21,845 in taxes. However, because you have a child and spent more than $3,000 in qualified daycare expenses, your tax liability gets reduced by the $2,000 tax credit minus the $1,200 dependent care child tax credit. This leaves your total tax owed down to $18,645. $18,645 divided by your taxable income of $137,570 equals an effective tax rate of 13.55%. As a comparison, most people tend to want to retire on around 85% of their total gross income currently. For this married couple, that will be around $150,000 per year. However, some, or many, can get by on even less. So for the sake of this example, let's just assume a retirement income goal of $120,000 per year, or about 10 grand a month. If you're 30 years old, assuming an average inflation rate of 2.5%, then 30 years from now, $120,000 per year will actually be closer to $250,000 in retirement. Assuming the tax rates will not change, which I suspect they will, then $250,000 minus the standard deduction of $24,800 leaves us with a taxable income of $225,200. The kids are gone, so no more tax credits, and there's no more 401k deductions against your gross income. 10% equals $1975, 12% equals $7260, 22% equals $19,976, and the remaining is taxed at 24%, which is $12,996, leaving a total tax liability of $42,207. This results in an effective tax rate of 18.74%. Going back to my first question, feel welcome to leave a one-word answer in the comments below. Do you think you will have a lower or higher effective tax rate during your retirement years compared to what it is for you today? Okay, so listen, lots of hypotheticals in here. Many things can change both politically and with the tax system over the next 30 years. The point of this video is to bring financial awareness and help educate you on how to calculate your effective tax rate to help you make better, educated decisions about your personal finances. You should consult with your CPA and with your financial advisor that knows the details of your specific situation before you make any decisions. This video is for education and entertainment purposes only. Smash the like button and hit subscribe if you like videos like this. If you want to learn more about my favorite tax deductions and tax credits, click this video right here. Otherwise, you might like this video instead. Thanks for watching. I appreciate your time.